Equity markets continued to drift higher over the month of February, led by continued interest in artificial intelligence stocks like Nvidia that beat earning expectations and led to a stark rally. In fact, we saw the biggest one-day gain in stock market value in history, with $277 billion added in market cap to Nvidia. What is surprising to the market, however, is the fact that even though the share price has been explosive over the last couple of quarters, at the same time, operating metrics like profit have increased at a faster pace relative to the share price reactions, and has actually made the stock even cheaper to invest in if you look at the trailing PE multiple. We continue to monitor the monetary policy developments quite closely in the United States. The reason for this is because the United States Federal Reserve set the global cost of capital and will largely influence the interest rate trajectory around the world. So we saw that US inflation dynamics actually surprised to the upside relative to Bloomberg expectations, where both core, excluding volatile items like food and energy, and headline inflation surprised on the upside. It is still encouraging, however, that the disinflation trajectory has taken place from the peak that we saw over the last couple of quarters. So we will continue to monitor developments to make sure that the disinflation trajectory is actually sustainable and to make sure that the level of inflation settles around the 2% target. However, if we look at some other alternative data points, like the services prices paid PMI index, we can see that that significantly beat Bloomberg expectations. And in fact, if you look quite closely, we can see that any reading above 50 on this chart indicates a significant expansion in prices paid sequential activity. So that really does indicate that service inflation continues to be a problem, and that we will need to see much more evidence of a disinflation trajectory take place within the services bucket, as even articulated by the US Federal Reserve. If we take a look at what the market perceives of the latest inflation numbers and some of the developments that have taken place more broadly, we can see that US break-even inflation rates, if you look at the 1 year in particular, has started to accelerate meaningfully in the month of February. And if you really relay this information to what the market thinks broadly about the path of the interest rates going forward, we can see that the implied policy path is a lot less deeper in terms of the amount of cuts that have been priced in the market. In fact, you can see that when we started the year, that about 6 to 7 cuts were priced into the market in terms of the implied policy rate path. And slowly over the last 2 months, you can see that roughly 3 to 4 cuts are now being priced by the end of the year, which is much more in line with the Fed's own dot plot in terms of the trajectory of the federal funds rate going forward. If we look over to Asian markets, we can see that the Nikkei actually hit all-time highs in the month of February. And we actually have to go back to the late 1980s and early 1990s to see similar share price reactions to what we have seen over the last couple of months. And in fact, what really popped the bubble decades ago was the fact that the Bank of Japan lifted interest rates to cool off the real estate market. If we look elsewhere in China, we can see that the 5-year loan prime rate was cut even deeper than the market was pricing in. In fact, according to Bloomberg expectations, 10 basis points cut was priced in, while the People's Bank of China actually delivered a 25 basis point cut. So a lot is being done to support the broader Chinese economy, and in particular, this is the key rate that is followed in terms of really trying to restore health to the property sector, because that is where majority of the lending takes place at the key 5-year rate. In the month of March, we'll be monitoring US fiscal developments quite closely. In particular, we'll be looking for more information on the latest stopgap funding bill in terms of the compositional intended expenditure going forward from a fiscal perspective, and what is actually likely to transpire given the fact that it is an election year.